So, your loan officer recommended a non-QM loan program to you, but what the heck are they even talking about? Welcome to the Mortgage Mindset. My name is Trevor Otsuka. I am a multiple state licensed mortgage advisor with Streamline Home Loans out of Las Vegas, Nevada. My goal here is to be an educational resource for you, teaching you about various mortgage loan programs and real estate. All of my contact information can be found in the video description below. Please don't hesitate to reach out if you need assistance with a refinance or if you're looking to purchase a new property. I'd be more than happy to assist you in that process. If you find this video content of value, please share the show, like it, subscribe to it, and let's get started. So you've been recommended a non-QM loan program by your mortgage advisor. But what are they even talking about? What does that even mean? So we're going to talk a little bit about that in this video so that you can understand what the differences are between a QM loan and a non-QM loan. In the world of residential mortgage lending, there are two primary categories for mortgage loans. You'll have QM, which stands for qualified mortgages. Then you also have non-QM, which stands for non-qualified mortgages. But what does it really mean for you as a potential borrower that is looking to take a loan to do a refinance or to do a purchase? After the 2008 housing market crash, the federal government decided that they needed to get involved in the mortgage industry and swiftly make some changes and implement a bunch of new regulatory laws. Prior to these changes being made, you could literally walk into a lender's office and get things that were called ninja loans. So you could walk in and just state that you make $1 million a year and tell me that you don't want to show me any income documentation, and they would still give you the money necessary or give you the loan needed to acquire that purchase acquisition. On top of that, lenders at the time were not required to verify your income and your ability to repay that loan, which is absolutely insane. That's one of the major reasons why the market did what it did, because of those types of deceitful lending practices. So the Consumer Financial Protection Bureau, along with the Dodd-Frank Wall Street Reform Act combined, they created a new rule or a new law that is called the Ability to Repay Rule, also called the QM rule or the Qualified Mortgage Rule. This rule was created to prevent poor lending practices, just like the ninja loan that we talked about a moment ago. And the rule itself required that any lender would now have to verify your income and your ability to repay the loan on the original loan terms. This rule is a major reason why the income documentation requirements are so stringent on loans like conventional, FHA, VA, and USDA. In addition to more stringent income documentation requirements, qualified mortgages or QM loans do not have negative features like negative amortization, interest-only payments, or balloon payments at a point in the loan term. In addition to that, total points and fees should not exceed 3% of the total loan amount. DTI cannot exceed 43%, and the loan term cannot exceed 30 years. So now that we know what a QM loan is, let's talk a little bit about what a non-QM loan is. Very simply, a non-QM loan is a type of loan that does not meet the requirements of a QM or a qualified mortgage. Non-QM loans will use non-traditional income verification methods to help you get approved for financing for a home loan. What does this mean? Simply put, this is just an alternative way for a lender to verify your income. Think of them as just being more flexible. These types of loans are great tools for borrowers to fill the gap if they are self-employed, if they have non-traditional income, or if they have credit issues that have been making it challenging for them to get qualified for a standard QM loan, things like bankruptcies and foreclosures. These loans are great for self-employed borrowers, real estate investors, foreign nationals, borrowers with significant assets, and medical professionals, just to name a few. These loans can be used for new home purchases, they could be used for rate and term refinances, and they could also be use to access the equity in your primary residence or in one of your investment properties. One of the major questions that I get all the time when we're discussing non-QM loans is, are they safe? The answer to that question is absolutely. The lender is still doing their due diligence in verifying your ability to repay the mortgage loan on its original terms. They're just using a more flexible way to do it. Some examples of that could be a bank statement loan, 1099 only if you're a self-employed contractor, where we're only using your 1099 statement or your 1099 transcript from the IRS, and we're not using anything else like your pay stubs. We don't need full tax returns, just to name a couple of examples of how flexible these non-QM product categories can be. This is going to be really important moving forward because I'm going to show you guys a ton of content and a ton of different loan programs that fall into this non-QM or non-qualified mortgage product category so that you guys can know what is available to you as tools to help you achieve your real estate goals. All right, that's it for this week. Thank you so much for tuning in to an episode of The Mortgage Mindset. As always, like it, subscribe to it, and share it with your friends or anybody else that you think could benefit from this content. See you next week.